Top 25 R&R, Record to Report, Interview Questions and Answers. In this video, we will explore the top 25 interview questions related to the Record to Report, R&R, process. These questions are essential for candidates looking to excel in finance and accounting roles. We will also provide detailed answers to help you prepare effectively. Whether you're a beginner or an experienced professional, this guide aims to enhance your interview readiness. 1. What is the Record to Report, R2R, process? The Record to Report, R2R, process is a critical financial management cycle that encompasses the collection, processing, and delivery of accurate financial data. It begins with recording financial transactions and culminates in the preparation of financial statements. Key activities include journal entries, month-end closing, and reconciliations. The primary goal is to ensure that financial reports reflect the company's performance and comply with accounting standards. Effective R2R processes enhance transparency, support decision-making, and facilitate regulatory compliance by providing timely and accurate financial information. 2. Explain the key components of the R2R cycle. The key components of the Record to Report, R2R, cycle include data collection, journal entries, reconciliation, consolidation, and reporting. Data collection involves gathering financial transactions from various sources. Journal entries are made to track these transactions accurately. Reconciliation ensures that records match, identifying discrepancies that need resolution. Consolidation combines financial data into a unified view. Reporting encompasses the generation of financial statements, providing insights into the organization's performance and compliance with accounting standards. Each component plays a vital role in achieving accurate financial reporting and analysis. 3. What are the major challenges in the R2R process? The R2R process faces several significant challenges. One major issue is data accuracy and integrity, as incorrect data can lead to misleading financial reports. Another challenge is the complexity of regulatory compliance, with businesses needing to adhere to various accounting standards and regulations, which can change frequently. Additionally, the integration of disparate systems and data sources can complicate reporting. Time constraints during month-end and year-end closing periods often pressure teams to meet deadlines, potentially impacting the quality of financial reporting. Finally, managing intercompany transactions can lead to complications, especially in multinational companies. 4. How do you ensure accuracy in financial reporting? Ensuring accuracy in financial reporting involves multiple steps. First, implementing robust internal controls is essential. This includes regular reconciliations and validations of financial data against source documents. Training staff on accounting principles and procedures enhances their understanding and execution of tasks. Utilizing technology, such as automated reporting systems, reduces human error. Periodic audits, both internal and external, help identify discrepancies early. Establishing a culture of accountability and transparency encourages team members to uphold high standards in data integrity. Regular communication among departments also fosters accuracy. 5. What is the role of journal entries in R2R? Journal entries are fundamental in the Record to Report, R2R, process as they serve as the initial point of data entry for financial transactions. Each entry captures the details of financial activities, including debits and credits, ensuring accurate recording in the general ledger. This process facilitates the creation of financial statements, which reflect the organization's financial position. Properly recorded journal entries are essential for maintaining compliance with accounting standards and provide the basis for audits. Regular reviews of these entries help identify errors and discrepancies early, contributing to the accuracy of financial reporting. 6. How do you handle month-end and year-end closing activities? Handling month-end and year-end closing activities requires meticulous planning and organization. Begin by establishing a clear timeline that outlines key deadlines for each task. Ensure all transactions are recorded accurately and ensure reconciliations are completed for all accounts, including bank and intercompany accounts. Communicate effectively with all departments involved to gather necessary information and resolve any discrepancies promptly. Conduct a thorough review of financial statements to ensure compliance with accounting standards. Finally, document any adjustments made and retain supporting documentation for audit purposes. 7. What is a trial balance, and why is it important? A trial balance is a financial statement that lists all the balances of general ledger accounts at a specific point in time. It serves as a tool for verifying that total debits equal total credits, ensuring the mathematical accuracy of bookkeeping. The trial balance is crucial because it identifies discrepancies that may arise from errors in recording transactions. It also acts as the foundation for preparing financial statements, helping accountants detect mistakes before finalizing reports. This process aids in maintaining compliance with accounting standards and enhances the reliability of financial reporting. 8. How do you reconcile intercompany transactions? Reconciling intercompany transactions involves several key steps. First, ensure accurate documentation of all transactions between subsidiaries, including invoices and agreements. Next, each entity involved must record the transaction in their accounting system consistently. Regular communication between entities is crucial to identify discrepancies promptly. Utilize a centralized reconciliation tool or spreadsheet to track intercompany balances and eliminate differences. Regularly review intercompany accounts during month-end close to ensure timely resolution of any issues. This process enhances financial accuracy and compliance with reporting requirements across the organization. 9. Explain the difference between accrual and cash accounting. Accrual accounting recognizes revenue and expenses when they are incurred, regardless of when cash transactions occur. This method provides a more accurate financial picture of a company's performance over time, as it aligns income with related expenses. In contrast, cash accounting records transactions only when cash is exchanged. This approach is simpler and provides a clear view of cash flow. While cash accounting may be suitable for small businesses, accrual accounting is generally preferred for larger organizations due to its adherence to generally accepted accounting principles, GAAP. 10. What are prepaid expenses, and how are they accounted for? Prepaid expenses refer to payments made for goods or services that will be received in the future. These expenses are recorded as assets on the balance sheet until they are consumed or utilized. As the benefit of the prepaid service is received over time, the expense is gradually recognized on the income statement. For example, if a company pays for a year's worth of insurance upfront, it would initially record the entire payment as a prepaid expense. Each month, a portion of that amount is then expensed, reflecting the usage of the insurance coverage. This ensures accurate matching of expenses to the period they relate to. 11. How do you manage fixed asset accounting? Managing fixed asset accounting involves several key steps. First, establish a comprehensive asset register that includes details such as acquisition costs, useful life, and depreciation method. Regularly conduct physical asset counts to ensure accuracy. Implement a consistent depreciation policy and record depreciation regularly to reflect asset value changes. Ensure compliance with relevant accounting standards, such as GAAP or IFRS. Utilize software tools for tracking and reporting, facilitating easy integration with financial reporting. Finally, train staff on fixed asset management procedures to promote accountability and accuracy in asset accounting practices. 12. What is depreciation, and what methods are used to calculate it? Depreciation refers to the allocation of the cost of tangible assets over their useful lives. It allows businesses to account for the wear and tear of assets used in operations. Common methods for calculating depreciation include the straight-line method, which spreads the cost evenly over the asset's life, the declining balance method, which accelerates depreciation in the early years, and the units of production method, which bases depreciation on actual usage. Each method impacts financial statements differently, influencing profit and tax calculations. Selecting a method depends on the nature of the asset and the company's financial strategy. 13. How do you ensure compliance with accounting standards, GAAP, IFRS? Ensuring compliance with accounting standards like GAAP or IFRS involves several key practices. First, maintaining up-to-date knowledge of the standards through continuous education and training is crucial. Implementing robust accounting policies and procedures that align with these standards helps mitigate risks. Regular internal audits ensure adherence and identify any discrepancies. In addition, utilizing accounting software that supports compliance can streamline processes. Collaboration with external auditors provides an additional layer of assurance, ensuring that financial statements accurately reflect the organization's financial position in accordance with applicable standards. 14. What is the purpose of a balance sheet reconciliation? Balance sheet reconciliation serves as a critical process in ensuring the accuracy and integrity of financial statements. Its primary purpose is to verify that the balances in the general ledger align with corresponding account balances, such as bank statements or other financial records. By systematically comparing these figures, businesses can identify discrepancies and take corrective actions promptly. This process helps maintain trust in financial reporting and supports informed decision-making, ensuring that stakeholders have reliable information for assessing the company's financial health. Regular reconciliations also aid in compliance with accounting standards and internal controls. 15. How do you identify and resolve discrepancies in financial statements? Identifying discrepancies in financial statements involves a systematic review process. Start by comparing the current financial statements against prior periods, budgets, or forecasts. Utilize analytical procedures, such as ratio analysis, to spot unusual variances. Conduct detailed account reconciliations to ensure that balances align across different records. Engage with relevant departments to gain insights into transactions that may cause variances. Once discrepancies are identified, investigate the root causes, whether they stem from data entry errors, misclassifications, or unrecorded transactions, and implement corrective actions to resolve them. 16. What is the role of ERP systems, e.g., SAP, Oracle, in R2R? ERP systems play a crucial role in the record to report, R2R, process by integrating various financial functions into a single platform. They facilitate real-time data collection, ensuring accuracy and consistency across financial reporting. By automating routine tasks like journal entries and reconciliations, ERP systems reduce manual errors and enhance efficiency. Additionally, they provide robust reporting tools that help organizations analyze financial performance and maintain compliance with accounting standards. This integration allows for streamlined workflows, better visibility into financial data, and improved decision-making capabilities. 17. How do you handle foreign currency transactions in reporting? Handling foreign currency transactions in reporting involves several key steps. First, it is crucial to determine the transaction date's exchange rate for accurate valuation. All foreign currency transactions should be recorded in the functional currency using this rate. At month-end or year-end, adjustments may be necessary for any unrealized gains or losses due to fluctuating exchange rates, ensuring that financial statements reflect the current values. It's important to maintain detailed records of all currency transactions for compliance and audit purposes, while also using ERP systems for automated conversions and tracking to enhance accuracy and efficiency. 18. What are key controls in the R2R process to prevent fraud? Key controls in the R2R process to prevent fraud include segregation of duties, ensuring that no single individual has control over all aspects of a financial transaction. Implementing access controls restricts sensitive data to authorized personnel only. Regular reconciliations help identify discrepancies promptly. Additionally, conducting periodic internal audits and utilizing automated systems for transaction monitoring can enhance fraud detection. Training employees on ethics and compliance also fosters a culture of integrity, making it harder for fraudulent activities to occur within the organization. 19. How do you manage audit requests and documentation? Managing audit requests and documentation involves a systematic approach. First, establish a clear communication channel with the auditors to understand their requirements. Next, gather all necessary documents such as financial statements, supporting schedules, and transaction records. Organize these documents logically, often by category or date, to facilitate quick access. Implement a tracking system to monitor requests and responses, ensuring all inquiries are addressed promptly. Regularly review processes and documentation for compliance with regulations, making updates as needed to streamline future audits. 20. What is the difference between statutory and management reporting? Statutory reporting refers to the financial statements prepared to comply with legal requirements, such as those mandated by tax authorities or regulatory bodies. These reports follow strict guidelines and standards, ensuring consistency and transparency for stakeholders, including investors and government agencies. On the other hand, management reporting is designed for internal use, focusing on providing insights for decision-making within an organization. These reports may include key performance indicators, operational metrics, and forecasts, tailored to meet the specific needs of management and help guide business strategy. 21. How do you streamline and improve the R2R process? To streamline and improve the R2R process, organizations can focus on several key areas. Implementing automation tools can reduce manual data entry and minimize errors, leading to faster closing cycles. Standardizing procedures across departments ensures consistency and clarity. Regular training for staff enhances their understanding of processes and systems. Utilizing data analytics can provide insights into performance metrics, allowing for continuous improvement. Establishing clear communication channels among teams fosters collaboration, helping to quickly address issues and enhance efficiency throughout the R2R cycle. 22. What KPIs do you track to measure R2R efficiency? Key Performance Indicators, KPIs, for measuring record to report, R2R efficiency often include the following: cycle time for month-end close, which tracks how quickly financial statements are prepared, the accuracy rate of financial reports, indicating the number of errors found during audits, and the percentage of reconciled accounts within a specified period. Other important KPIs might include the cost per journal entry, the number of adjustments made during the close, and the level of compliance with reporting deadlines. These metrics help identify bottlenecks and improve the efficiency of the R2R process. 23. How do you handle ad hoc financial reporting requests? Ad hoc financial reporting requests are managed by establishing a systematic approach. First, assess the request scope and timeline, ensuring clarity on the specific information needed. Next, gather relevant data from reliable sources, utilizing accounting software to streamline the process. Collaborate with stakeholders to understand their requirements and provide insights. Ensure data accuracy by cross-referencing with existing reports. Finally, present findings in a clear format, allowing for easy interpretation. Regularly review and optimize the process to improve efficiency for future requests. 24. What is the impact of automation on the R2R process? Automation significantly enhances the R2R process by increasing efficiency, reducing manual errors, and speeding up financial closing cycles. Automated solutions streamline data collection, journal entry creation, and reconciliation tasks, allowing finance teams to focus on analysis and strategic decision-making. With automation, organizations can ensure consistent compliance with accounting standards and improve accuracy in financial reporting. Real-time data availability enables quicker insights and fosters better collaboration across departments, ultimately leading to improved financial performance and agility in responding to market changes. 25. How do you stay updated with changes in accounting regulations? Staying updated with changes in accounting regulations involves several strategies. First, subscribing to relevant accounting journals and newsletters ensures access to the latest developments. Attending industry conferences and seminars provides insights from experts and networking opportunities with peers. Participating in professional organizations, such as the AICPA or ACCA, offers resources and updates on regulatory changes. Additionally, taking continuing education courses helps maintain knowledge and compliance. Regularly reviewing updates from regulatory bodies like the FASB or IASB is essential for staying informed. In this video, we've covered the top 25 R&R, record to report, interview questions and answers to help you prepare effectively for your upcoming job interviews. By familiarizing yourself with these questions, you can boost your confidence and enhance your understanding of the R&R process. Whether you're a seasoned professional or just starting your career in finance, these insights will be invaluable. If you found this content helpful, please like the video and subscribe to our channel for more informative resources. Your support helps us continue to create valuable content for you. Thank you for watching.